Hey guys, I'm here today with another video to tell you about the newest options trade I've made. This one is on Shopify. It's a stock I've been talking about a lot lately. I think it's fallen down into a very interesting valuation. And I feel very good about the trade I've made. So before we jump into the trade though, please do consider hitting like and subscribe. It'll really help the channel. Every single subscriber helps at this point. Makes a big difference to me being able to continue to make content for you guys and participate in the YouTube online investing community. With that, let's jump into the trade. So this is the trade I've made today at 10:08 a.m. We sold a put on Shopify. A lot of people are more familiar with call options than put options. They like to make those big YOLO bets on those out-of-the-money call options that have a low probability of success. But if they do succeed, they can have massive payouts. That's sort of where you get the Wall Street bets crowd going. This is the opposite way, really. We have a pretty much guaranteed return. The risk is lower and the reward is maxed though. There's no way we can make more than we've made on this commission. So we agreed to buy the stock here at $560 a share on April 22nd. Now that's significantly lower than where the stock's trading today, which means it would have to drop below that price in order for me to lose money on the trade. Now, why am I doing this? Because I am being paid $12.50 per share in order to take on this risk of having to potentially buy it at $560 on this date in case it goes lower than $560. Now, don't be fooled by the number $12.50. This is a options contract, which means it's 100 shares, and that is the price per share. So $12.50 times 100 shares means I'm actually receiving $1,250 in this trade. So not very bad for only a 1 month out, well out of the money stock, and quite happy with this return. And by the way, you got to love these interactive brokers commissions we've got here, 31 cents. That's absolutely amazing. My old broker used to charge me something like $12 for each option trade. Plus, if you have more than one contract, then it would go up by several dollars. So I'm definitely loving these commissions, but that's just a little tidbit here. Let's go on and take a look at the chart. So this is a 6-month chart of Shopify. We can see over the last 6 months, stock has really fallen off a cliff. Now, this is primarily due to macro market headwinds. We have rising interest rates, and in environments like this, stocks with a high price to earnings multiple generally fare quite poorly, and that's what we've seen over the past, say, 6 months is stocks with a high price to earnings multiple, stocks that don't make profits are just getting hammered. Shopify was a $1,700 stock not too long ago, less than 6 months ago, and now we're down at $700. So more than half in the value has been cut off this company, which means the multiple that used to look pretty expensive is starting to look quite attractive to me. Now, in addition to that, we also, in my opinion, have started to form a base here around just above 500, call it 530 maybe, dollars per share. And I don't think we're gonna, at least it doesn't look to me like we're gonna drop significantly below that unless there's some major news that comes out. So I feel like this is a pretty safe play in that, and we would have to break through that resistance in order to incur any losses. Now, my price line, as I said, is 560 minus the $12.50 I receive. So really it's about 548, which should be around here, which is right near the base, slightly above the base, but honestly If I get put the stock down there, I'm completely fine with it because I think I've got it at a great price and I'm confident it will go up in the not too distant future. So that's what I'm seeing with the charts. Now, I also did do my research on the company, which you always should do when making a trade like this. Make sure it's a company you actually would like to own and not just something where you're fishing looking for those premiums. In fact, the reason I originally made this trade is because I was looking at this chart and I was thinking to myself, damn, I really wish it had dropped back down to those prior low levels because I would love to buy some more there. And then I thought to myself, wait, if I would love buying it there so much, why not just sell a put on it? And if it drops to that level, then I get to buy it at the price I wanted to buy it at. If it doesn't drop to that level, then I just get free money. It's a win-win to me, which is a great way to have your trade set up where you're happy if it ends in the money and happy if it ends out of the money. Let's go on to the next chart. This is just a funny little one-day chart. So nothing too material here, but I just thought I'd show you I purchased this or sold this option around just after 10 o'clock in the day. So that was about here on the chart. We had a good run up after that. We actually were up on the day for a little while before we went back down, but we are still above the levels where I made this trade. So that's always nice to see. It's only one day. We have a month to go, obviously. And the nice thing about this trade is I'm okay if it does go down. As long as it doesn't absolutely drop off a cliff, I'll be fine. Now, this window is the Interactive Brokers Probability Lab, which I always like to take a look at when I'm making an option trade. I think it's a useful information to see. And what this is showing us is, based on the price of the premiums we're receiving, how the market thinks the probability is of the stock ending this period at certain prices. So if we look right at the top of the bell curve here, the median, the most probable up here, we can see the market thinks it's most likely to end this month around 695, which is basically where we are right now. So that makes sense. Like the highest probability is not changing too much. But in order for us to basically end in the money and have to buy it, we're looking about there. So we really have the majority of this bell curve is safe for us. We only have the sum of these percentages to the left that could be a risk. So we're looking at about a 9% chance based on the probability lab that we'll have to buy the stock. Personally, I think it's a little less than that, but the markets are actually quite volatile right now. So you never know for sure. And you have to have a plan in place what to do if you are going to get put the stock, which I do. I'm comfortable getting put the stock because I said I would love to be able to buy it at this price anyway. So that's not a huge worry for me. But you do want to look at this and see what the probability is according to these market algorithms anyway, that you will end up in the money on this trade, which means it's below where you'll be put the stock. You can also with this tool, adjust it and have kind of differences between what you think the probability is versus what the market's pricing the probability is. And using those differences, try to identify opportunities based on, how you think the stock will perform. So it's a pretty neat tool, pretty useful. And if you're with Interactive Brokers, I urge you to check it out. Now let's talk scenarios here on what might happen depending on where the stock ends at the end of this month. So we have got three scenarios here. Scenario number one is, I would say, the most likely scenario. That's where on April 22nd, Shopify is still above $560 a share. That means I just receive $1,250 and I go on my merry way. Sorry for the incredibly bad handwriting there. Still getting the hang of this writing pad. Now, scenario number 2 is that the stock closes below 560, but still above 547.5. Now, where do I get that number from? That's the 560 minus the 1250 I already received. So in this case, I actually have made money, but I would be assigned the stock unless I sell the contract before that end of day, April 22nd. So I'd most likely prefer to sell the contract, take whatever the difference is in this scenario, and continue on. Or alternatively, I could roll that contract over into a new end date, say maybe a month out. I'd receive more premiums for that. And I think the longer this goes, the more likely in the long run Shopify will go up and eventually, past that 560 level, as it is a growing company. And eventually, I think it will definitely surpass that share price. Now, scenario 3 is, I would say, the least likely. Well, maybe scenario 2 is the least likely because that's a very small margin there. That's only like, $12 a share price. Scenario 3 is the stock closes down below 547. And what does this mean? Well, basically, I would have to buy the stock, buy buy 100 shares of Shop at the price above, so at 560, let's say. But I've received $1,250, so my cost basis is really that 547.5. So this means that I need basically $54,000 of cash available to make that purchase. Alternatively, what you can do is roll over. And that's basically extending the contract. You can change these numbers around. You can do basically anything, right, for the right price. But usually what I do is I keep the exact same strike price. I roll it over to a next month. And usually you can, if it's not too far below where it hit, you'll receive more premiums because someone on the other end of the trade thinks, well, maybe it'll drop further, so I'm willing to pay for that chance. And I think it will eventually go back up. So rolling over is my most likely option, just to save the cash on hand. But if it drops way, way down below this price, like say, I don't think this would ever happen, but let's say Shopify is $300 a share on April 22nd somehow. It would have to be like massive fraud on behalf of the company and management for that to happen. I can't see any other way, like an Enron situation. But if that happened, the rollovers no longer work because you'd have to pay money to basically continue the rolling over. So in that case, I would take assignment and I would probably just sell some other stocks in order to be able to buy Shopify. But, should that happen, I'm okay with it. As I said, I'm happy today with buying at this price. So in 30 days, I'm buying at the price that I would like to buy today. And eventually, I'm still confident that we will get back above that price and I will make money in the long run. So to me, this is a win because we get $1,250 for free. So this is the big win. Probably, I would say the biggest win. Scenario 2 is we make less than the full $1,250, but we make, the difference depending on where it ends. So this is like a little win. And scenario 3, I still call this a win because I get the stock cheaper than I'm able to buy it today, and I want to buy it. So we have a win-win-win, and to me, that's the best trade you can make in options. A few other factors here. Now, implied volatility gives you an idea of how much premium you're getting for taking on the risk. And if you look at some stocks, let's say bank stocks, if I were to make a similar trade on a bank stock, sell a put, we're probably looking at maybe 15-20% lower than where it's trading now. I get next to nothing. And that would be because the implied volatility is really low. And the reason it's really low is because banks are quite steady and no one on the other end wants to give me money for that trade because they don't believe there's a chance it will fall. So what we're seeing here with a 74% implied volatility basically means the market is quite jittery right now, and they're willing to pay these high juicy premiums for these option contracts to have that safety net. So that's why we're getting such a juicy premium, which I actually love, because more money in the bank for me. It's actually already dropped, so I checked later today, and we're now down at about 69%. So the implied volatility, which is good if you're already in the contract. If you see that implied volatility going down, it means the stock is being more stable, because remember, we can also win this trade simply by the stock being flat. It doesn't have to go up. So flat is also good for us. Now let's talk risks. You always want to think about the other side of the trade, because there's two sides of every trade. Someone is buying this off of me. Someone is giving me this money. So they must think there's a decent chance Shopify goes down. So what's our risk here? Well, obviously, as I said, we have about the 55K that we have to have available to buy the stock. That's our maximum risk. But also, what factors could come into play that might cause this? Well, in the most recent quarterly earnings call, the CEO did say they're forecasting a bit of a weaker growth. Still growth. Last quarter, Q4, they had growth rate in the mid 40s, I believe, 40% or so year over year, which is great, and that's why they were trading at such a high multiple. They're expecting a bit slower growth in Q1 of this year, so I guess that could potentially cause the stock to decline. But quite frankly, if I look at the price to earnings, they're already trading at such a low multiple. I don't think that's a big problem if they grow only 30% in the next quarter. And then they do expect growth to pick back up again later in 2022. So potentially there could be, the market doesn't like their Q1 results or something along those lines. And that's another thing you want to look at when you get into these trades is when are the quarterly results released, because that can be a big mover of the stock. And if you're selling one of these options and that quarterly, the end of the quarter falls inside that date period, you want to be aware of that, because those results, if they're a big surprise one way or the other, will move the stock price. In this case, Shopify is due to report their Q1 quarterly earnings on April 27th, and the end of the trade is April 22nd. So one way or another, we don't have to worry about the quarterly results causing increased volatility on this trade. That's the only real risk I can see, other than, the macro market continuing to drop, the NASDAQ continuing to drop. But I just don't think this stock, to me, it's starting to get to the point where almost value investors should come in, because it's dropping so low. So that's a risk I'm willing to take. I've thought about the other side of the trade, and I'm happy to make this deal. I will let you guys know how it goes, whether we pocket that full chunk of change or we end up buying the stock or we roll over. Definitely be transparent on what happens there, and make sure if you're doing these trades, you understand all the risks. You have the cash available on hand to cover this trade if you do get put the stock, if you are forced to buy it. And just be careful out there with options, because if you don't know what you're doing, you can get burned on it. So that's all for today. Thanks for watching. Once again, please consider hitting like and subscribe. It really helps the channel, and I'll see you next time.